Cathie Wood. In this video, we're going to take a look into Cathie Wood's portfolio with Ark. Specifically, we'll be looking into the most recent update of her largest and most diversified portfolio, the Ark Innovation ETF. So this is going to be really interesting, and if you're an investor, you don't want to miss it. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. I'd like to thank today's video sponsor TradingView, but more on them later. Because for now, let's get straight into it, and I won't make you wait at all, because this right here is a list of Cathie Wood and Ark Innovation's top 10 investments. So I'm going to talk you through these companies briefly. And the reason I say briefly is because anyone can just buy this ETF or some of these companies. But as an investor, what's really interesting here is to understand Cathie's overarching investment focus, because in particular there are 5 platforms of innovation which she believes are changing the world around us. So this list of companies, they are simply the best opportunities building on the 5 platforms, but there are many more. So in first place, perhaps unsurprisingly, we have Tesla. Now what makes Tesla so interesting, and is the reason Cathie has invested so much in them, is that they are not just a car manufacturer. They are also an artificial intelligence company in their pursuit of self-driving cars. And they are an energy company as they build more and more efficient batteries. As we'll hear from Cathie in an interview shortly, one of the key themes is that she likes to invest in companies which branch across numerous different industries. Now second is Square. Square offers sleek payment devices that you may recognize, but much more than that, they also offer banking services and crucially are able to acquire new customers much cheaper than traditional banks. In third, we have Teladoc, the healthcare company focused on the treatment of patients over the telephone and via video calls. Fourth is Roku, the entertainment company with a device similar to the Amazon Fire Stick, their own smart TVs, and a streaming platform. In fifth, we have Zillow, the innovative real estate listing and investment platform. Sixth is Baidu, the Chinese tech and artificial intelligence company who are building out their autonomous taxi service similar to, you guessed it, Tesla. Now this is particularly interesting because we know that this autonomous taxi service is why Cathie is especially bullish on her investment with Tesla. In seventh, we have Spotify, the most popular music streaming service in the world. Eighth is Shopify, the e-commerce company which gives regular people like you and me the tools to easily sell products online and on social media. In ninth, we have CRISPR, one of the leading companies in the world focused on gene editing. Now for me, the genomic revolution is the single most interesting aspect of Cathie's work, as there is so much potential value in treating conditions in the very earliest stages. And in 10th, we have Zoom, the video calling service that I think we've all become far too familiar with over the past year. So those are the top 10 companies in Cathie Wood and Ark's main portfolio. But like I say, what's really interesting here is not the specific companies, it's understanding the 5 platforms of innovation which she believes will change the world in the coming years. So let's hand it over to her to explain what these are.
So the 5 innovation platforms are DNA sequencing, that's foundational to find those mutations. Energy storage, so the shift from the internal combustion engine to electric vehicles. Robotics, especially with collaborative robots, which will be covered in sensors and able to work alongside human beings, increasing the productivity of human beings. Artificial intelligence, which is going to change the line item of, every line item of the income statement. So every company, every industry, every sector is going to be transformed. In fact, a good proof of concept there is Salesforce.com. About 2 years ago released Einstein, which is artificial intelligence as a service. Einstein, from 0 2 years ago, maybe 2.5, is now making 8.6 billion predictions per day for companies. It's phenomenal. And then blockchain technology is the fifth platform that we think is going to be quite disruptive.
Okay, so while those technologies, they may sound really interesting, many of them have actually been around for many years and haven't had much impact on the world. So why exactly does Cathie think now is the right time?
Well, we are centering our research on something called Wrights Law. Now, Wrights Law is very specific to innovation, and it's actually a relative of Moore's Law. Moore's Law, however, is a function of time. Wrights Law is a function of units. And it basically says for every cumulative doubling in units produced, costs decline at a consistent rate. So what we are looking for in terms of impact is figuring out, have costs associated with one of these platforms drop to a low enough level that they're going to unleash waves of demand and get us into that exponential growth curve.
So the argument behind cost reduction is a compelling one. I mean, after all, it just doesn't matter how much a technology could in theory change the world. If it's too expensive, it simply won't be adopted. Now let's hand it back over to Cathie to share more details on these 5 platforms and why we should all be paying attention to them. But first, I want to say a thank you to our sponsor, TradingView. For those who don't know, TradingView are the #1 tool for giving you the live information and market insights that you need to improve your investing. With over 10 million users worldwide, they have a vast community of like-minded investors sharing their ideas. Their data spans across over 50 stock exchanges all over the world, and with their integration into over 30 of the most popular cryptocurrency exchanges, they are always on the leading edge of consumer demand. TradingView offer over 100 pre-built indicators that investors can plot onto their favorite investment's price chart with just the click of a few buttons. You can use the platform to set alerts on prices, bullish and bearish indicators. You can stay up to date with the latest in earnings reports and follow real-time news from leading sources. And you get all of that with a $120 discount when you sign up to the annual plan. So click through the link in the description if you want to learn more. Now, let's dive deeper into what I think is the most interesting of the 5 platforms: DNA sequencing and gene editing.
DNA sequencing costs now are below $1,000. Last year, the number of whole human genomes sequenced around the world was 2.4 million. That was half of all the whole human genomes ever sequenced in history. So we're already at the tipping point, and we believe that number is going to go to 100. So that's almost a 40-fold increase in the next 5 years. So that is truly exponential growth, and it is going to change healthcare decision making. It's bringing real science into healthcare decision making for the first time. So our geneticists, and you're going to have one, so am I, are going to be able to identify for the first time the needle in the haystack. They're going to be able to identify which genes in our genomes have mutated. In other words, they've developed a programming error. And now with CRISPR gene editing, following it up, we're going to be able to correct those programming errors. It's going to be incredible to catch in stage 1 and then edit it away. We think that's going to be possible in the next 5 to 10 years, and probably sooner than that. In the genomic space, we focus on long-read sequencing, which is going to be transformational. It is much more accurate and reliable than short-read sequencing. And so we're excited about the multi-screening opportunity that we think by 2025 will reach a low enough cost with long-read sequencing so that it will pay. Reimbursement will be there for those 40 and over. So we can all start screening earlier for this disease associated with older age and either prevent or cure, please God, with gene editing in stage 1.
Next, we have battery storage, which is so important to improve if we want to bring down the cost of electric cars.
Battery costs are an easy explanation. When we started the firm, I think the question was, would electric vehicles ever be economic? Would they ever take off? And today, of course, we're looking at electric vehicle prices soon to drop below gas-powered car prices on a like-for-like basis. And by 2025, the average the average car, like the Toyota Camry of the electric vehicle space, will be priced at $18,000 compared to $25,000, $26,000 for the average gas-powered car. And we know that electric cars are better from a couple of points of view. Certainly the environment, but also they're just better cars. If you use metrics like 0 to 60 miles per hour, how many seconds does that take? So we think for that, just that one part of the auto market is going to scale, this is a global number, at an 82% compound annual rate during the next 5 years. Think about that, anything growing that much. People just don't believe that's going to happen, but we do. We think there will be a wholesale shift so that we go from 2.2 to 2.3 million electric vehicle cars sold last year to 40 million in 5 years. And that will be almost half of all cars sold globally. And we'll probably have entered the autonomous realm as well.
Next is robotics.
Collaborative robots, we believe, are the reason that the robot industry will see exponential growth. So the robots that we are used to seeing are typically in cages in auto manufacturing plants. They're very dangerous. Collaborative robots will be outfitted with sensors and will be able to work alongside human beings. There are labor shortages around the world. They'll take the menial tasks that nobody wants to do or that just don't pay very much at all, and they will help to elevate human productivity. We think human beings will oversee them and be able to do their jobs much, much faster than they have historically. So we believe that Teradyne is the leader here. Teradyne bought a Danish company called Universal Robots, and we think collaborative robots will insinuate themselves into any industry, every industry. So you'll have artificial intelligence and collaborative robots and the fusion of the two.
Fourth is blockchain, specifically Bitcoin and Ethereum.
Part of fintech and digital wallets, of course, is Bitcoin. And we're astonished to see, we're not astonished to see the price elevate, because we expected institutional to become a bigger part of the equation as we saw sort of the infrastructure moving into place. But what we didn't expect was that Bitcoin would become a part of the balance sheets of institutions. So Square, 1% of its assets, 2% of its cash is in Bitcoin. MicroStrategy, I think, more than 100% of its cash is in Bitcoin. And just this week, MicroStrategy hosted a conference for institutional investors to show them the way, a good way to diversify your cash. And given everything going on in the DeFi space, the decentralized finance space, we wouldn't be surprised to see Ether moving in this direction. It's probably going to take a while.
And fifth is artificial intelligence.
If AI, artificial intelligence, is as impactful as the internet was, then this is a $30 trillion opportunity. And right now in the market, we believe it is a value today at $1.5 trillion. So if you do that compound annual rate of return over the next 20 years, that's a 14% compound annual rate of return. Now we think it's going to be a lot faster or a lot more exponential than that. And the reason is it's going to be so much more impactful than the internet. The internet transformed media, it transformed retail. It did not transform healthcare or the industrial sector or the utility sector. AI, deep learning, is going to transform all of those. So we think there is a 25% compound annual rate of growth to be delivered from opportunities associated with artificial intelligence. One of the reasons autonomous will happen is because artificial intelligence training costs are dropping by 37% per year. And we're seeing the size of artificial intelligence models growing by tenfold per year. So there's a huge amount of progress being made because the costs are dropping at such a rapid rate. And we can make this progress now. One of the reasons these models are growing so quickly is that to do natural language processing takes 10 times the computing power that computer vision demands. So, and we see the progress being made in natural language processing. I don't think we expected this for another 5 years. So even we have been taken aback at the progress. And I do believe a lot of it is associated with the costs coming down as rapidly as they are.
Okay, so those are some pretty compelling points, and it's really difficult to listen to all of this and not get excited about the potential opportunities here. At the same time though, there's an important point that I want to share with you. So recently, a few people have reached out to me and asked me to manage their portfolios for them. While I'm really flattered, I had to decline as I don't do that. But I've had a back and forth with a few of these people as I want to try and help them out where I can. And there's a pattern that I keep on seeing on repeat. People are investing 50% or more of their money into ETFs like Cathie Wood's Ark. Now listen, I'm a huge fan of Cathie Wood and Ark. That should be pretty clear from this video. But I need to share this with you. So Cathie and a team at Ark, they simulated a few different portfolios to see how allocating a portion to innovation, i.e. investing in Ark, would impact the overall results. I've talked about this in previous videos, so I won't go too in depth here, but the point is this. Even in the maximum allocation, they still only invested 20% into innovation. 20%. And these are the most famous innovation investors in the whole world. So please remember that it's possible to be bullish on Ark, Cathie Wood, and these 5 platforms of innovation over the next decade. And at the same time, be well diversified. In fact, if you invest more than 20%, for example, you're more likely to be tempted to sell when the dips come. And believe me, there will be major drops along the way. Allocating 20% or less is what allows you to focus on the minimum 5-year time horizon. Now, I'm interested to know what you think. Do you agree with Cathie or not? If you do, which of these 5 platforms do you think is the most interesting? Let me know your thoughts in the comments below. Thank you for watching. I will see you again very soon.